Hi, everybody. There's probably going to be more people coming in as we start. That's okay because we're going to get started with people who, you know, we want to give Ilana enough time to give her presentation, and we want to leave enough time for questions and answers, and then to talk about the health benefits too. I just want to introduce our negotiating team this year. Is myself, President Maria Rafinsky, Vice President Mary Barbas. Mary, you may not know Mary. Mary's down in Lakewood with our Lakewood Trimble people. We have our secretary is not here yet, Diane Jasek, and our treasurer is Tracy Coddington. Our other co-chair is Lisa Weirdan. Tracy Morales-Wright is in the back. She's also on the committee. We have an alternate member on the committee, Nina O'Leary, who's not here quite today. She's a delegate in the ED. But that's our negotiating team. We started negotiations yesterday. We presented our proposals to management, and now there's kind of like a waiting time. And then we're going to be getting together again on Monday, and then there's various dates that we have to meet with management. The changes that are happening in the pension, we have filed an unfair labor practice because there were certain terms that were negotiated in the 2006-2009 contract, and there's specific terms in the contract. So we filed an unfair labor practice. The medical center did not negotiate those terms with us. We're also going to be grieving it, so it may or may not go to arbitration on those changes. But be that as it may, the pension changes are very difficult for everybody to understand. So trying to figure that out and then to try to explain things to you, we reached out to CWA in DC, and we were very pleased to be able to speak to a person who can translate it into our understanding, and that is Alana Bovee from CWA in DC. She is their financial economist, research specialist, so she understands all that and puts it into terms that we'll understand. So we're going to talk about that, and I'm sorry that we don't have the projector, but Alana's going to go through the PowerPoint presentation, and then we're going to open it up to questions. We're filming it because we're going to put it on the website, but if you ask a question, you're not going to be filmed. So we're just going to put the question up on the website, and then, you know, your voice probably isn't, you're going to hear your voice. So, but your question will be on the bottom, and then Alana will answer it. And then after that's done, then we'll talk about the health benefits, which they just called us on Monday before you got it in the mail and asked to meet with us. And there's a lot of changes. So I know a lot of people, their feeling is that, well, what are we going to do? The changes may happen with both of them, but what we have to do as a union and as a group is that we have to stay united, and we have to demand language that, so it just doesn't change every single contract, because that's what happens. Every single contract, it changes, and that's because we've got language in the contract that allows that. But if we stand up as a unity, as united, and stand up and say, we're not going to take this anymore, every single contract changing. And we want to be compensated for the money, because we get a raise and then we don't get the raise because they increase the contributions, and now they're hitting our pension. So we'll talk about the health benefits after Alana does her presentation. And then as we talk about the health benefits, you could ask questions afterwards too. So I'm going to turn it over to Ilana.
Thanks, Maria. Thanks to all of you for coming out. I know Maria said you have some crazy 12-hour shifts. So to come afterwards and talk about pensions of all things, I don't envy you. But I'm going to try and make this kind of as simple as possible and as easy to understand as possible, because it can be it's very complex, and most people don't really understand these things very well, but it doesn't have to be that way. I mean, the general concepts can be pretty understandable if they're just spoken about in the right way. So I'm going to talk first about the benefits that you currently get. Different people have different types of plans. Then I'll talk about the changes that the company is going to instill, and then I'll talk about, kind of how that relates to you a little bit more directly as well. So first of all, but on slide 4 there, this slide just kind of gives an overview of the different types of retirement plans generally. At St. Barnabas, there are 3 types of plans. What's referred to as generally like a traditional pension plan. I think it's referred to as the legacy plan here. Then there's also a cash balance plan, which is actually very similar to a traditional pension plan in a lot of ways. It's designed a little bit differently, which I'll talk about, but those 2 types of plans under federal rules act the same, basically. And then there's a 401k plan that, so people either have the legacy plan or the cash balance, and then everyone has the 401k as well as one of those 2 other plans. Basically, in a traditional pension and a cash balance plan, the way it's different from a 401k plan is that it's a pooled account, first of all, that's owned by the employer. So the employer says, here's what your benefit is. Your benefit has this particular design. And so based on your wage and your years of service, you can pretty easily predict what you're going to get in retirement based on that benefit design. And the employer is on the hook for basically everything. The employer is on the hook to make contributions every year. Employees don't contribute to these plans out of their own paycheck. The employer has to make all the contributions in order to fund that benefit in retirement. And they do these kind of complex calculations in order to figure out what that money looks like, because it is kind of a difficult thing to know. If I'm 25 years old, what is, how much do I need to fund now to fund a benefit at age 65? But they hire actuaries to do that work, and then they put in the money. They put the money for everybody into a pooled trust, and then they hire investment managers to invest that money, and the money grows over time, and so by the time that 25-year-old retires, it's there to fund their retirement. And they have to do that. The employer has to do that under federal rules. Let's say the money is not there for some reason. The stock market tanks like it did in 2008, so that investment trust gets wiped out or something like that. Doesn't matter to the employee. The employer is still on the hook to pay that benefit when you retire. That benefit is guaranteed, so even if the employer has no money, there's no money in the pension, the employer has no money, is going bankrupt, in that scenario, your benefit is still guaranteed. It's guaranteed by the federal government. There's an agency called the Pension Benefit Guarantee Corporation that basically acts like the FDIC does for banks. The PBGC is for pensions. So if there's no money to pay your benefit and you're retired, the PBGC will pay it. So it's a nice thing. It's a really nice thing that your employer says, here's where your benefit's going to be. I'm going to fund it. I'm going to invest it, and you'll have it. It'll be there for you when you retire, no matter what. That's a pension plan. That's a cash balance plan. Again, they're a little bit different. I'll talk about the differences between the 2, but they're the same in that way. The 401k works very differently. It's an employer-sponsored plan, meaning that the employer picks an administrator and maybe makes some contributions. But it's an employee-owned account, so you can be in the plan, you don't have to be in the plan. You can make contributions, you don't have to make contributions. The employer can make contributions, but doesn't have to make contributions at all. Whereas again, in the other plan, you don't make the contribution, the employer has to and is on the hook for them. In this plan, unless it's in your contract, a collective bargaining contract is a different story. But outside the terms of that contract, the employer doesn't really have to contribute anything. They can set up the account for you, and then you're on your own. You choose your own investments, you choose how much to contribute, and again, the employer might make a match. And then once you retire, you basically have this account balance that's accrued based on contributions and your investment earnings. You have this lump sum amount, and then you have to choose how to draw it down once you retire. Whereas in a pension and a cash balance plan, it's a monthly income for the rest of your life that you can outlive. That's the other benefit to a pension. As long as you live, that money will be there coming every single month if you choose that annuity option, which is the default. That's the default option. In a 401k, again, you get this lump sum, and then you can purchase an annuity, but you have to go to an outside like life insurance company and buy that, which can be a little bit pricey, and most people don't do it. Anyway, those are the general differences between traditional pensions, including cash balance plans, and a 401k kind of plan. Are there any questions there before I go on? Same as a 401k, almost entirely. It's just if it's a nonprofit employer. In 401k and 403b come out of the IRS tax code. Like that's the actual section of the code, and they just never got a better name than that. So yeah, it's the same. It's basically the same exact thing. Any other questions? Okay. So let's see. In terms of do you all, my understanding is that the legacy pension plan was available to people who were employees before 2007, and then 2007 came, they decided to move to a cash balance, and so all new hires were in the cash balance, and the older employees were able to choose between the legacy pension and the cash balance. Yes, yes.
No, you can actually have a 401 with the legacy, but you didn't get any matching, which was what the people with their balance.
Right, I noticed that, and I think actually the contribution rates are higher for those who chose the cash balance than for other, like the post 2007 people, I think.
Depending on their age.
Right, right.
Those who are retired, they have a higher match.
Right, right, right. So it actually, it would be helpful for me to know do you know how many people, if you're in the legacy plan? Okay. And how many people are in the cash balance plan? Okay, it's about even. Okay. So, okay, if you turn to slide 7, St. Barnabas Legacy Benefit Example, I'm just going to walk through some examples of the different benefits, and maybe this will make it a little clearer. So this is the legacy benefit. The benefit formula on the left there, it's very simple. It's your years of service times a multiplier. Slide number 7, the title is St. Barnabas Legacy Benefit Example. So for years of service before 1989, there's a different multiplier, but let's just assume we're talking about after 1989. But it works the same way. The post-1989 multiplier is basically 1%. If you're making wages over $245,000, lucky you, it's higher for wages above that amount, but I doubt anyone's there. So it's 1% of your pay every year. And so it's very simple. So we have an example here. Jane earns $50,000 a year this year. Let's say her prior accruals gave her a pension of $9,000. For 2013, her accrual would be $50,000 times the 1% multiplier, which is $500 a year. So you add that to the $9,000 she's already accrued for prior years. That's $9,500 a year. Again, it's important to note that that's $9,500 per year as an annual income. It'll be paid monthly, so divided by 12, and you get $750 a month. And that's paid monthly for as long as she lives, if she's single. Does that make sense? For the cash balance plan, it works a little bit differently. The design is a little bit different. In a cash balance, it's not your years of service times a multiplier. It's an annual pay credit. Again, it's a percentage of your pay, plus an interest credit on what's called your virtual account balance. Some people call cash balance plans actually like a hybrid between a pension and a 401k because you do get this, what they call virtual account balance, which looks like a lump sum, and a lump sum is what you get in a 401k. But I don't know, I think that misconstrues what a cash balance plan actually is, because it actually is a virtual account balance, and that's not actually how the default is paid. So just walking through this, let's say, you know, it's the same Jane, she has $50,000 a year, she has 11 years of service, let's say, and a current account balance of $40,000, this virtual account balance. For 2013, her pay credit would be, again, her wage times 4.5%. If you go to the chart on the left, between 10 and 14 years of service, the pay credit is 4.5%. Plus, she gets an interest credit. The interest credit is either a treasury rate or a floor of 2.25% per year, which is on the account balance that exists. Treasury rates, if you know, have been very, very low, so you're probably getting that 2.25%. So 2.25% of the $40,000 balance is $900. So she accrues $3,150 for the year. Add that to the $40,000, and she gets $43,150. Again, this is a virtual account balance. So this would actually, the default would be that she would get paid a monthly income. You know, again, actuaries do this complex calculation and say, here's what that is equivalent to as a monthly income stream. And that's what the default payout would be in retirement. Or she can take it as a lump sum. In cash balance plans, many, many people just choose to take the lump sum. So when she retires, she can take the $43,150 and run. But then the plan is off the hook. You know, then if you take that as a lump sum, then you know you get nothing else from the plan ever. You know, and you spend it down as you want, but that's all you get out of the plan. But again, that $43,150 or whatever she's accrued by her retirement age, again, it's guaranteed. It's guaranteed. If the plan is underfunded, the employer goes out of business, it doesn't matter. She'll get that money. Any questions there? And the same with the pension, by the way. 401k, again, works differently. Going on to the next slide. There's no real benefit formula here, right? It's just your contributions, maybe your employer's contributions, and then whatever interest you get on that money, depending on how it's invested. So right now, I think for most employees, for most later hires at least, the employer contribution is a 25% match up to 4% of pay. So if you contribute 4%, your employer will match a quarter of that. So the maximum match is 1% of your pay. If you do less, they'll do a quarter of whatever you do contribute. If you do more, they still just contribute the 1%. That's a cap. Okay. So let's go back to Jane. She's still earning $50,000. Let's say she contributes 5% of pay. That 5% of pay is $2,500. She still only gets the 1% match, 1% of her pay, because that's the maximum, and she's contributing, you know, above that to get the maximum. That's $500. So her total accrual for the year is $3,000, and then plus whatever interest she might get on that balance throughout the year. Prohibit that for active employees. Some plans allow like terminated employees that are not yet at retirement. So if you quit and move on to another job, but you're not at your retirement age, some plans allow that you can take the money out, but these plans do not. And we talked with the employer about that, and they said they're not going to change those rules. So, but again, it might not be the worst thing in the world because, again, if it's still in that plan, then it is still guaranteed. Once you take it out, it's not guaranteed anymore. What else? And again, new employees, you know, who are hired after this are not going to receive anything from either of those two plans.
I think she's just explaining like what the legacy was and how, you know, going through like Jane, you know, and her salary, and then explaining what the cash balance was for Jane, whoever Jane Doe is, and then explaining what just a 401 is. And then she's going to go into now what the hospital is going to do. So it's just kind of giving a history.
Yeah.
Like financial, you know, history.
I just think it's helpful to have an overview of how, you know, what the current plans are, how they work, and then how they're going to change. And I'll talk about that right now, actually. It's basically, you know, the idea is the difference between a pension and a cash balance plan and a 401k is there's this risk-return trade-off, right? Pensions are not risky for employees. The benefit's guaranteed. It's going to be there when you retire. You know, you're not on the hook for anything. The employer's on the hook for everything. The employer makes basically all the decisions. But the employer's making all the decisions. You know, maybe you need more money in retirement and more money than that pension is going to give you, maybe you think you could do better in financial markets than the cash balance interest credit is going to give you, things like that. So the 401k gives you that kind of flexibility, but you can contribute as much as you want. You know, you can make your own investment decisions, etc. But but they're very risky. You know, you also stand to lose everything in the market, and so that's kind of the trade-off between the two types of designs. So now I'm going to go through the changes to the retirement plans. Basically, those two traditional plans, the legacy plan and the cash balance plan, are going to be frozen for everybody, and which means that the account balance that you have to date, or the pension that you've accrued to date, that $9,500 a year that Jane got, or Jane number 2 in the cash balance, the $45,000, whatever her account balance was, that stays. That stays, that's fixed, that's frozen. When you retire, you'll get that, okay? And it's still guaranteed by the federal government, et cetera, et cetera. But you're not going to accrue anything else. Right, the one exemption is, in the cash balance plan, you'll still get that 2.25% interest credit. You'll get 2.25% interest on the cash balance every year. Or if treasury rates go higher, if 1 year average treasury rates are higher than 2.25%, you'll get that rate. That's unlikely to happen anytime soon, though, I think. So you will accrue that, which will basically, maybe cover inflation, unfortunately, and that's about it. But so those benefits that you've accrued to date remain, but they won't really grow. The legacy will just stay the same, right?
There's no interest accruals on
No. The question was, can you take the money from the pension, I'll add, or the cash balance and move it to your 401k? The answer is no, unfortunately. There are actually federal rules. Okay. The question is, what if you leave and go to a new employer before retirement? Is your cash balance still there? Is it still accruing the 2.5 or 2.25% interest? Yes. As long as you're vested in the plan, as long as you have that 3-year vesting requirement, then that benefit is still there. It's still accruing the 2.25%. But like I said, you cannot take it with you. That's not an option right now. It's not federally prohibited. It's federally prohibited for active employees. Once you leave, it's not prohibited, but these plans prohibit it. Like, the employer is allowed to say you can't take it, and that's what they're saying. Retire, once you hit your retirement eligibility, then you take it. Until that time, it stays with the plan. It continues to accrue the 2.25%. I think it's 65 is the retirement age. I think it is. I'll double check. But I think for this plan it is 65. Any other questions about that? The employer cannot revoke it. The employer cannot revoke it. It's a federal rule. If they promised you the benefit for your past years of service, they told you it's there, yeah, they have to provide it. Any other questions about that? Yes. It's 3-year vesting for the legacy and the cash
So that
balance.
means
I think that the employer is going to expedite their vesting, is that right? Yeah, so that's a really good question. So people that right now have less than 3 years of service, they wouldn't be vested in these plans. I think the employer said, I think I remember from that phone call, they said they're going to make everyone who's currently an employee vested.
It'll stay like in limbo until that occurs, and then it goes into
I don't think
But I
so.
think they are definitely.
Yeah. So they can't, they can't just take it away from those people. But those people are going to have very, very little, you know, in the account, but they will have it. Right.
New hires coming in are just going to get the 401 and the match. They're not going to get any people right now who have the cash balance. You can correct me on cash balance and legacy, like that's frozen. You'll have it when you retire. Like if somebody new person comes in the door tomorrow, they're not going to have any cash balance. All they'll have is their 401k, and the hospital will match a certain amount that they get, that they put into their 401k, basically giving the employee the responsibility of their retirement funds.
Right. So and the employer is increasing their contributions to the 401k pretty significantly, and I'm going to talk about that next. Are there any other questions about the pension being frozen right now? Okay. Okay. Yes. Positive news is that they are increasing the contributions to the 401k pretty significantly. They're also making a couple of other changes. They're decreasing the vesting period for the 401k. Speaking of vesting, right now it's 20. First of all, employee contributions, anything you contribute to a 401k, is automatically vested. There's no way they can take that money from you that you've contributed out of your own pay. But in terms of their contributions, their matches, and so forth, right now it's 20% of their contributions per year over 5 years. So after year 1, you're 20% vested. After year 2, 40%, 60, 80, 100. They're moving that up to a 3-year schedule. So the first 2 years are going to be the same. This is on slide 13, by the way. The first 2 years will be the same, 20% after year 1, 40% after year 2, but then you jump right to 100 in year 3. So everyone will be fully vested in the employer contributions after 3 years. The other design change they're going to make is that they're going to automatically enroll all employees. So right now it's voluntary participation. So, you know, when you get hired, you go to HR, you fill out a 401k form, and you join the plan, and you decide on your contributions, you decide on your investments, and all of that. If you don't fill out that form, if you never return it back to HR, then you're probably not in the plan. You know, it's voluntary. It's like signing up for health care benefits or life insurance or anything else. They're going to change that. They're going to make the default be everybody's in the plan, including current employees. They're going to put everyone in the plan. You can always opt out. You can always fill out, you know, another form, an alternative form, and opt out of the plan if you want to. But the default will be everyone will be enrolled, which tends to be a good thing because, you know, there are these opt-out provisions. But a lot of employees, you know, want to join 401k plans. This is just generally never get around to it. Not quite sure what investments to choose or things like that. For whatever reason, they kind of fail to enroll even though they would like to. So automatic enrollment tends to make people happy that they, you know, they've enrolled without having to do a lot of work. But the biggest change is going to be, like I said, the employer is going to increase their contributions pretty significantly. They're going to have 2 types of contributions now. Before they just had a very small match. Now they're going to have the matching contribution, but they're also going to have what's called an automatic contribution, which means it's automatic. Employees are automatically enrolled, and then they automatically get a contribution. So whether or not you contribute to the plan, they're going to make this contribution. And then if you do contribute, they'll make the additional matching contribution. So what this looks like, it's on page 14, the new 401k employer contributions. Those are the rates. And The automatic contribution rates are based on your years of service and your age. So that first column there is for anyone under age 50. Their contributions are from 0.75% of your pay to 4.5% of pay at 20 years. And again, everybody gets that no matter whether or not you contribute to the plan. If you're over age 50, those rates are increased by 1% up the line. So they start at 1 3/4 and go up to 5.5. So everybody gets that no matter what. Then if you choose to contribute to your 401k, the last column there is the match that the employer will make. Right now, like I said, for most employees, it's 25% up to 4%, so that's a maximum 1% of pay. They're going to beef that up to 75% up to 4%. So the maximum goes from 1% of pay to 3% of pay. Does that make sense?
The matching.
Correct. Everybody will get this. That was the question. It doesn't matter which plan you used to be in. Clarify that with the employer. The question was, say I'm age 49 now, once I hit age 50 next year, will I get the higher contribution rate? I think the answer is we don't know, and we should double check with the employer. That's a very good question. Right. Yeah, the answer is probably no, because we think it's been asked, but we'll double check.
I'll have to check, because I don't even know if they contribute with per diem. We're gonna have to ask. We're gonna have to ask.
Okay.
That's a lawyer question. We'll have to ask.
Yeah. Sorry, you said 12 years of service?
Yeah.
So you'll get 3.5% automatic contribution. You'll get 3.5% from the employer. And then if you contribute 4%, you'll get another 3. So 3.5 plus 3 will give you 6.5 if you contribute 4. If you contribute nothing, they'll just give you the 3.5 of your total pay. Right. We can go through an example here on slide 15. Yes.
These are all good questions. Base, I will check.
Yeah. The question is it based on base pay or overtime as well? If you have any other compensation, yeah, we should double check. And, the problem is I think a lot of these details have not been fleshed out. I mean, they have to print what's called, a plan document that details all of these issues and details, and they haven't done that yet. All we've gotten is this very short summary, and so I think a lot of these details we do have to push back and make sure we get answers to. Any other questions right now? We can go through an example of the. Yeah, you can contribute. You can contribute as much of your pay as you want. Up to the IRS rules say you can contribute up to like $17,500 a year tax free. But the employer is only going to match. They're only going to match the first 4% of your pay, which is, and they're gonna do it at a 75% rate. So the maximum they're gonna match is 3%. You can contribute above and beyond that up to the IRS maximum, but they're not gonna do any more than that 3, plus the automatic contribution. Yes? I think it's going to stay the same unless you change it. It'll stay the same unless you change it. You can change it periodically. Usually it's every quarter or so you can reassess. They have an open enrollment period. But yeah, if you're doing 5, then that's great because you'll get the maximum match right off the bat.
Separate.
Right, but I mean,
You can have a 403 and a 401.
Yeah, if I do 10% on the 403, and I want to get my contributions, I can lower my 403 and then.
Yes.
Yes, I would do that.
Right. What's important, I think, Alana, and correct me if I'm wrong, is that we need to instruct the nurses that if you're not giving anything into the 401k, you're not going to get that 3% added to whatever they're contributing to us. So in order to get the biggest bang for your buck, you have to just pretend you didn't have that money and put the 4% in, and then you'll get your full amount.
That's right.
They also did say, you can correct me, Lon, they said that if you don't choose the, how you put your money in 401k, they are going to automatically put you into a default investment,
Yeah.
which, like, I always thought was like really, really safe. But Alana said not all the defaults are safe, right?
Yeah, so, right, so, and this goes back to the automatic enrollment thing too. So if a company chooses to automatically enroll employees, like I mentioned the company is going to do here, they have to make certain decisions for you because you're not filling out that paperwork. And, the 2 big decisions they have to make are what is your contribution rate and then what investment, where are you going to put that money? And so the company has said that the default contribution rate, FYI, is going to be 0. So you'll be enrolled in the plan and you'll get their automatic contribution, but you won't be making contributions, and so you'll receive none of the match. So you'll basically be leaving that extra 3% of compensation that they're offering on the table. So like Mary said, it's very important, I think, for people to understand that and make every effort you can to contribute at least the 4%. If you're currently doing that in 403B, move it over, and you'll get more money that way because the employer will match most of it. And the other decision that they have to make for you is an investment option. There are these safe harbor rules under the federal government so that employers don't get sued that say you can default people into what's called a target date fund, and that's what the company is doing. They can basically either leave it in cash or a money market account or do one of these target date funds. And they've chosen the target date fund, which basically works like it kind of rebalances your portfolio as you get older because the traditional wisdom is start riskier when you're young, more stocks, fewer bonds, and cash when you're young because you have more time to accrue interest and take more risk. But then as you get older, kind of switch that up and get more conservative as you get older. Target date funds are relatively new. They came around the past 5 or 10 years for people that kind of don't want to have to do that all the time. The fund does it for you. The thing about target date funds, though, I think part of the reason because they're still so new, they can vary very widely in what they do. So in the financial crisis, a lot of people close to retirement lost a lot of money, and they said, well, wait a second, I was in a target date fund, I shouldn't have lost that much, right? I should have been very conservative. Some of those target date funds weren't. These people were in their 60s, and they were still 50% invested in stocks or something like that. And they didn't realize they were, they kind of thought the fund was making it more conservative than that. But for whatever reason, it wasn't. And so, some target date funds are great, you know, and some of them, you know, some of them might be more risk though than you want. Some of them might actually have high fees attached to them, which is also problematic. And so, you know, but, you know, Maria said like, oh, a target date fund, like that's conservative. That it's not necessarily all that conservative was my point. And especially if you're young, the whole point of a target date fund is when you're younger, it's definitely going to be riskier, you know, because that's kind of, again, the traditional wisdom that you can be riskier when you're younger. So, you know, take a look at the investment options in the plan, and you know, you should always make your own decisions on these things. You know, you shouldn't just kind of let the company do it for you, because everyone is going to have different circumstances that make sense for them.
They do help you. Fidelity is very good. If you call them or you go online, they'll spend a lot of time on the phone with you, and you can ask questions, and you know, they'll tell you for your age. I mean, it's not that they're not the last source. You know, I would take it and, you know, research it yourself and look at it, but they do tell you. You know, when I call and tell them I'm 64, you know, I shouldn't be in certain areas, and he tells you why, which is something as nurses we wouldn't know. You know, I can't tell you the last time I looked at a stock in the paper. So you need to be proactive for yourself in this.
If you go to slide at the very end there, or close to the end, slide 24, I am not a financial, like, investment expert. I am not a financial planner. I don't give out this advice, but the basic rule of thumb on investment, well, first of all, you know, as someone coming from retirement policy and, you know, living and breathing this stuff, always contribute the maximum amount that you can. You want to contribute the 4% to get the full match, of course. You should think about contributing even more than that. The rule of thumb is somewhere between 10 and 15% of your pay that people need every year, you know, from age 25 until you retire. If all you have is the 401k and Social Security and not a pension, and that's what's occurring here. So, you know, contribute, you know, as much as you possibly can. Remember that it's tax deferred, so if you're contributing $100, you know, the loss of disposable income will be less than that, you know, maybe $80 or so. And so, you know, you want to contribute as much as possible, that's A. But B, in terms of your investments, you know, just, you know, you should just think, you know, what level of risk am I comfortable with based on, you know, just how comfortable I am, you know, with the stock market in general, but also where, you know, my other savings is, and, you know, maybe what your spouse has in terms of retirement income. But in terms of the investment options in the plan, I think it's really important to also check the fees, because those fees can be very substantial, and every dollar they're taking away in fees is not coming back to your principal and earning money. So, you know, the higher the fees, the lower your return, basically. And what's called index funds tend to do very well. They're low cost. They basically just follow a market, so they'll be an S&P 500 index, and it just follows whatever the S&P 500 is doing. They're low cost, and they tend to do just as well, basically, as these actively managed mutual funds that can be very costly. So in the end, you're better off. And then, like I said, the automatic enrollment is this Fidelity Freedom Fund, which is that target date fund that I talked about. And I don't know the specifics of that fund in particular. I haven't seen the prospectus or anything. Not that I would have great advice for you anyway, because I'm not a financial planner.
Are they joint?
I'm sorry, I just wanted to, just excuse me a minute.
Yeah, sure. Yeah. So, right, 401k plans are tax advantaged in the sense that both the employer contribution and any contributions you make out of your pay, you pay no income tax on that now. You have to pay income tax on it eventually. Basically, when you take it out in retirement, you have to pay your income tax then. But people's taxable income tends to be lower in retirement, so you're probably going to pay less down the line than you would pay now. And also, the investment returns are not taxable year to year, like a capital gains tax or something. They don't charge you on that, like they would if you were just investing in these stocks, like outside of a 401k. So those are the tax advantages, but you do still have to pay some taxes on your 401k contributions. Most significantly are the FICA taxes. So you still have to pay your Social Security and Medicare tax, you know. But that's not changing. I mean, that's what is currently the case, has always been the case, that's just the federal rule, so. Yes.
Now,
No, the maximum, the IRS max is the IRS max, but for your contribution.
Yes.
So the rule is, I think it's $17,500 if you're under age 59, but then there's an additional $5,000 if you're over that age or underage.
Yeah, all of that.
Yeah.
So they say-
That's your contribution. Then the employer can contribute on top of that. And the total contribution can be up to, I think it's $51,000 a year, so you'll be fine.
Oh,
If that's the question, yeah.
yeah, that's.
You can't contribute more, but your employer contribution is still tax deferred, yes.
Okay, they,
It's the same 401k, yeah, that they've always had.
can you just
Okay, we're gonna double check on
You
that.
guys answered all the questions that everybody asked, and we'll put them on the website, we'll be putting this whole thing back onto the website, so you guys can get your answers to your questions.
Yes. That's how a 401k works, unfortunately. It's unlikely that you'll lose everything in the market. But yeah, like, you know, even your principal is not guaranteed in a 401k. Because it's, you know, you're betting on Wall Street basically. Now you can make very conservative investments. You can keep some of it in cash. You can keep it in treasury bonds. And you know, if you're doing that, then you're not going to lose that money, but you're also not going to get a lot of interest on that money, or any interest if you're keeping it in cash, you know. So yeah, there's no benefit guarantee there. I mean, and people saw this in the financial crisis. Like I said, people in their 60s saw 30–40% of their money wiped out.
It's going to be 100%.
When we get our statements in the mail every quarter, if you look at it, there's a picture on it that shows you where you're in, and whether it's high, you know, volatile market. Yeah, it's a pie
Yeah,
chart.
go right up and down the
And you
website
can,
too, and look
you
at
can
it.
see it, you know, and when you talk to your representatives, when you call in with your employer ID, you know, to the website on which you can go through, they will explain the whole thing to you, so you'll know where you are, if you're in a risky area or what.
And that's why I say, like, you know, what level of risk are you comfortable with? You know, not just based on your finances, but based on, you know, your gut, your personality, you know. Some people, you know, want to gamble, and other people don't want to lose a dime, you know, and it's a trade-off. You could do very, very well in very risky things, but you could also do very, very poorly. So, any other questions?